You are tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here. We do strategy. 5 minutes on the clock. Let's get to work. The board is set for Tuesday, February 3rd, 2026, and the morning tape reveals a widening schism in the American economy. On one side, the Dow Jones Industrial Average is roaring after a 515-point surge, catalyzed by a landmark trade architecture. President Trump has finalized an agreement with Prime Minister Modi, slashing tariffs on Indian goods from 25% to 18%. In exchange, India is severing its reliance on Russian crude, pivoting entirely to American energy and technology. This Buy American, Build Indian framework is injecting massive liquidity into industrial heavyweights like Caterpillar and the major energy players. However, cross the floor to the Nasdaq, and the atmosphere is considerably colder. The AI premium is being stripped away as investors realize that the era of the $100 billion blank check is coming to an end. Shares of Nvidia are under pressure following a clarification from Jensen Huang regarding the much-touted $100 billion partnership with OpenAI. The truth is out. There was never a binding, single-round commitment for that figure. It is a one-step-at-a-time arrangement, contingent on infrastructure milestones that are now being scrutinized for their lack of discipline. As Oracle announces a massive $45 to $50 billion capital raise to build cloud capacity for its tech titans, the market is beginning to ask a dangerous question. Is the return on this infrastructure actually materializing, or are we simply building cathedrals in the sand? The hard truth is this: the AI stall we are seeing isn't a crash, it's a discipline. The market is finally demanding that tech companies prove their worth without the safety net of infinite cheap liquidity. For years, growth at all costs was the mantra, but in the Walsh era, yield at any cost will be the reality. The reality check for the Nasdaq is that a 30% year-over-year growth rate is no longer impressive if your capital expenditure is 50% of your revenue. Meanwhile, the Dow's triumph is fragile. It is built on the volatile foundation of trade deals and executive orders. If the India deal hits a snag, or Russian oil finds a backdoor into the Indian market, that 515-point gain can evaporate faster than it was printed. You cannot build a fortress on a foundation of hope. Conventional wisdom tells you to diversify by owning an index fund. I'm telling you that today, an index fund is a trap. You are buying the overvalued AI uncertainty of the Nasdaq and the politically sensitive volatility of the Dow in one toxic package. Here is your actionable moves for today's session. 1. Rebalance for the trade pivot. Identify your exposure to export-heavy tech and move that capital into the tariff winners. Specifically, look at the auto, ancillary and engineering sectors that are now cleared for an 18% entry into the US market. The Dow's strength in manufacturing is where the defensive floor is being built. 2. Audit your AI holdings for binding commitments. Any tech company in your portfolio that relies on partnership projections rather than contracted revenue needs to be trimmed. If Jensen Huang can walk back a $100 billion figure, your mid-cap AI play can walk back its entire 2026 guidance. 3. Hedge against index volatility. With the S&P 500 at a stress test high, move 15% of your liquid capital into short-term treasuries. As Walsh prepares to take the chair, the yield curve will likely steepen, providing a safe harbor with a guaranteed return while the indices fight for a direction. It is time to stop watching the scoreboard and start reading the playbook. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp.